And thanks for joining us. I'm Roby Brock. Well, this past week, the Federal Reserve Bank raised key interest rates 0.75% for the fourth time in this last year. It's part of an aggressive move to curtail inflation and keep the economy on track. I caught up with Davy Carter, regional president for Centennial Bank in Jonesboro, who also happens to sit on the Memphis branch board of directors for the St. Louis Fed. 0.75 of a point interest rate hike that the Fed's passed along this week. Tell me a little bit, this is like the fourth interest rate hike we've had since the Feds have gotten aggressive in fighting inflation. How is it playing out with your customers in your market?
Well, it's certainly been top of mind for everybody. I mean, it's the lead, story on today's show and on, front page of newspapers, et cetera. So we're getting a lot of phone calls, particularly on the deposit side, about deposit rates and CDs, and it's just been a big move. 475-point hikes, consecutively. It's moved rates up significantly. So it's changed not only the deposit liability side on the bank, but also borrowing costs on the commercial and residential lenders and consumer lenders. So the entire landscape has changed, and our customers are holding in there well. We'll be fine. The average Fed funds rate was higher than this over the last 50, 60 years. So I know it's a big change, but at the end of the day, I think we'll all be just fine. We have to adjust a little bit, but.
Let me ask you this. The whole point of doing this is to curb inflation, to get a handle on inflation, which we still see some inflationary numbers that we don't like out there when you look at some of the month-to-month stuff. I guess, is the policy working?
Not yet. And I think that's been evidenced by their continuing to do the 75 basis points. So those are big steps, to get to where they want to go. Now, Powell yesterday did say that we're going to probably start taking some smaller incremental steps as we get closer to the end. But he also said, in addition to that, but we're probably going to go a little bit higher than what we said in the past. So I think we'll see as they start to take these smaller steps, 50 basis points, maybe 25, a couple of meetings after. I think then we can start to see that things are going to are getting close to being at the end. But when you move from where we were, to 2% and 2.25%, that's still really, really low rates. And so I don't think we've seen the effects of what they're trying to do yet. But when we get Fed funds at 4.5%, 5% or even higher, I mean, that'll slow some stuff down. I mean, that's just that'll slow things down then, but we're not there yet.
What do you kind of envision as the end game here? When will you feel like the moves that have been done, and when will it be when you see inflationary numbers that are back to below 2% where they have been, consistently over the last 10 years? Will it be some sort of economic activity reading? What are you going to be looking for to say, all right, I think we're there now?
Yeah, all of the above. I mean, the Fed's they're very data oriented. So, they're going to be looking at all of this inflation data, but, that's mostly, it's looking in the rearview mirrors. So they're going to, and they've said publicly, they're probably going to go a little too far, but they feel like that they're going to err. It's better to err on that side and then potentially unwind that than to miss this, because the real fear here is that this uncontrollable inflation, and I know it's painful, particularly for customers on the borrowing side, but if you think about the alternative and you're losing 8 to 10% of your purchasing power with your money every year, which is what's been going on at a minimum, that if that doesn't get under control, then that's much worse situation. So I think what we'll see as far as the interest rate hikes, whether they're coming in, I think we'll see that gradual 50 basis points, then a quarter, and they'll start tapering this thing down, very much like stopping your vehicle. I heard that analogy earlier today. You're going down the highway at 80 and you want to stop. You got to slow down at some point. Without coming to just a sudden slam on the brakes. So I think that's, what they're looking for. I think just from your viewers and our customers and people here, I think, that's what we need to track, is just watch the tapering off of these hikes. But they're going to be more interest rate hikes. I mean, it's going to happen. It's going to happen in December. It's going to happen in the next meeting, and it'll happen in the next meeting. Unless something unexpected happens.
Your driving analogy there indicates to me you've not taught a teenager to drive lately. I know you've taught a few, but I don't know if you've taught a few lately, because the slamming on the brakes happens a lot when you're teaching them for the first time. So,
Fair enough. Yeah.
some have said that the Fed's moves are too aggressive. I guess I'll just give you a chance to address that criticism, that critique. You seem to be indicating it's not too aggressive, that they're doing it at a pace that is trying to get caught up with what was in that rearview mirror that you talked about.
Yeah, that's my opinion. I think they waited too long. I mean, they, in good faith. I mean, I think in good faith they thought early on that this was transitory and it was temporary, and they were wrong. And it got so far out ahead of us and them that there was just a big gap there to catch up. So look, there's no good alternatives here. They waited a little too long, and they have to catch up because getting inflation under control is more important than the slowdown that this interest rate increases are going to cause. So, look, I hope they don't succumb to political pressures and things like that, because I think they just need to get their job done and to go ahead and get this where they think they need to be. Look, it's so I believe they're doing the right thing, and I hope they don't stop until they start curbing some of this. We can't have 8, 10, 12 in some instances. I mean, look, one of our customers are talking about 25, 30% cost increases. The things we read in the paper, 8 to 10. I don't really know that I believe that anyway. And so again, to the viewers, I know some of this could be painful if you're on the borrowing side, but if things are left to run its course the way they are without them doing this, you're losing your buying power in every dollar that you have. And that rate that you're losing, that we're all losing the buying power, is less than what these interest rate hikes are. So they've got to get it up to that level where it's going to stop some of that. So kind of for those reasons, I think I don't think they're being too aggressive. They just need to go ahead and do it and get the job done.
I understand. And you think that going, like, say, if you see these incremental increases that you're talking about, like, say, if they were to just go ahead and raise it another whole full point, that's too aggressive too quickly, is what I'm kind of reading between the lines there. Is that accurate?
Yeah, I think so. I mean, we're close with their 3.75 to 4% Fed funds now. So as they reach they said the target was 4.6 before. I think that's moved. I think the market's pricing in a 5, maybe 5.5 Fed funds rate. So the closer they get to that end rate, they call that the terminal rate. They're going to kind of start slowing that down and incremental, kind of just fine tuning it back, the best they can, towards the end. But you think about Fed funds goes to 5.5%, and the financial institutions in the country, the deposits are, sitting at the Fed earning, risk-free 5.5% at the time. All the time, cost of funds are going up for all banks just because of these interest rate increases. Well, that puts the credit risk when you go out and lend money. That's going to be we're going to see New York prime and the 8% range, if not higher.
You sit on the board of directors for the Memphis branch of the St. Louis Fed. Tell me I'm not asking for any secrets to be revealed, but what do you do when what is the information you're providing to the Feds from that venue, from that seat that you hold?
Yeah, that's a great question. I laughed. We had a joint meeting with the Seattle group the other day, and I told the main guy, I said, man, what a time to be on the Fed. Like, everybody just now get blamed for all this stuff. I thought this was supposed to be a kind of a fun deal. It's not fun anymore, but it's a great question. So, what happens in those meetings is really a bottom-up approach. I mean, I go and I try to share stories without names and business names or people, but I share stories about what's happening in Jonesboro, what's happening in Marianna, what's happening in East Arkansas, what's happening in Fayetteville, what's happening all across Arkansas, real-life customers on the ground. and tell them, the stories that I'm hearing and the things that they are seeing. And all of my other colleagues on that board are doing the same thing. And all that information funnels up, to the decision makers and in St. Louis, and they have a vote on the FOMC, and they take that very seriously. Those are really the only forward-looking leading indicators that they have. They look at a lot of historical data. So I feel like my job is, and my role in that on that board is to share what's happening to business people and everyday Arkansans, where they can see what their decisions, try to make their decisions based on some of the things that are happening actually on the ground and not just in some textbook and looking at historical data.